In this lesson, we're going to talk about terminology. And there's going to be a lot of new terms for people who don't know anything about options. We're going to start with some basics here. Now, I'm not just going to read a bunch of definitions off and hope that you remember them. For most of these things, we're going to go a little bit deeper and understand a little bit more about the term. Don't worry about this. We're not introducing too many. There's more things we'll introduce you to over the course of other videos. But these are common terms. You're going to hear them all the time. And you will get very, very used to them very, very quickly. Before you know it, you'll just be talking like a trader. Now, I don't want to insult anyone's intelligence here, but there are people who don't know what bullish and bearish means or what a bull market or a bear market is. And okay, fair enough. You didn't do anything with the financial markets. I understand. But very simply, bullish market is when you think something's going up, whether it's the entire market, whether you're bullish on the price of gold, whether you're bullish on anything, Bitcoin, it doesn't matter. You just think it's going up. And conversely, as you can imagine, if you're bearish, you think things are going down. Next, we're going to talk about derivatives. Now, a derivative is just something that derives its value and is independent from an underlying asset. So options are derivatives. They derive their value from something we're trading the option on. So the option might represent a commodity like oil or gold or wheat, or maybe a stock, Microsoft, Apple, Tesla. It doesn't matter. It represents something, but it's independent of it. So as that underlying asset starts to move around, the options price is going to move. So it has a relationship with that underlying price. So if you own Microsoft shares, let's say calls on Microsoft shares, and the price of Microsoft starts to go down, well, the value of your call will go down in relation. If you owned puts, the value would go up. So there's two types of options. That's it. There's just calls and there are puts. Very, very straightforward. A call buyer gives that buyer the right to buy that underlying asset at an agreed upon price, the strike price, up until the expiration date. It's just a contract, but the buyer is paying that premium, is paying some money for that right to do that. Buying a call option is usually done when you're bullish because you expect the underlying price to rise. Now, someone who buys a put, that gives them the right to sell that underlying asset at that given price, the strike price, up until the expiration date. When you buy a put, you're generally thinking the market's going down. You're bearish on the market, or you're bearish on that particular underlying asset. A call gives that buyer the right to call it away from the seller. That's where the term comes from, right? You've got the right. You don't have to. If it's not worth it for you as the buyer, you won't have to. You've got that right to do it. And on the other side of the coin, a put gives the buyer the right to sell or put it to the person who sold it. So for every buyer, there's a seller. There's two sides to every transaction, right? If you buy something, well, someone had to sell the darn thing to you, right? So in the case of a call, someone who sells or writes a call, they're going to be obligated to sell that underlying asset at that predetermined price, at the strike price, if that call option is exercised by the buyer, the person who bought it. The person who buys is in complete control. You paid that money, you paid that premium up front. You've got the right to do something if you so choose. So you control it. You paid for that privilege with the premium. The seller took the premium, now has an obligation. If it's exercised, he will have to sell that underlying asset. On the other side of the coin, someone who sells or writes a put option has the obligation to buy the underlying asset at that predetermined strike price. If, of course, the option is being exercised by the person who bought it, who's in control. The person who bought that put is in control. If they exercise it, well, the one who sold it has that obligation to buy it. I went and created this beautiful, beautiful little chart here with these cute little bulls and bears. I don't know if teddy bears are appropriate, but that's all I made. Anyways, look, as I mentioned, there's calls and there's puts. That's it. You can only do two things with these calls and puts. You can buy them or you can sell them. There's not much to it. But sometimes we can get confused in our head. I know when I started back in the day, when I was studying for my options license, especially when you get complex strategies and you got all kinds of buys and sells going on, you have to think, okay, hang on. So there's puts here and there's calls. It's a bit of mental gymnastics at first. After a while, you get used to it, like anything in life, and this will just be like nothing. So don't worry about it. If you're buying something, if you're long, if it's a call, you've got the right. Either case, you've got the right to do something. Calls, puts, you bought it, you've got the right. You paid for that right. You've got the right to buy it at a certain price. If it's a put, you've got the right to sell it a certain price. If you're buying, if you're buying a call, you're hoping the thing goes up. If you're buying a put, you're hoping the thing goes down. If it's a call, it goes up, you got the right to buy it at a lower price. If it's a put, it goes down, you've got the right to sell it at the higher price. On the other side of the equation is the short seller, or the person who sold it short. They're obligated to sell if it gets assigned to them. And on the put side, they're obligated to buy the underlying at that specific strike price. All right, so expiry date, we've already talked about expiry date, so you should know what it is. That's when the contract ends, right? So if I say to you, hey, I want to buy that car from you for $5,000 at the end of December, if I still think it's worth me, if it's January 1st, too bad, that contract expired. So that's the date which the options contract expires. And that's also the last date which the holder, the person who bought that option, can exercise it if it's in their favor to do so. If it's not in your favor, you could still exercise it. It just wouldn't make much sense usually. If there's no value in the option expiry, 99.9% of the time, it's not going to be exercised. The option is worthless. So the seller walks away. They keep all the premium. The buyer also walks away from it. So if I pay $100 for a call and that underlying price doesn't go up or doesn't go enough for me to make it worth it, I'll walk away. You know what? I took my chances. I paid a little bit of money to see if that would work out. It didn't. But I didn't have to buy the underlying. So it's worth it. It was a bet. That's how most of the retail crowd looks at it. I suppose you could, there's an argument to say that everything you do in the markets is a bit of a bet. There's always some risk in the market. We can't eliminate the risk completely from everything we do. We can mitigate it and we can reduce it. And over time, that will usually play in your favor. But you can't eliminate risk. And I see I put a note in here again. I'm going to mention it again. Rarely will we hold an option to expire. If you're concerned about expiry, if you're concerned about, am I going to get assigned? Do I have to deliver 1,000 barrels of oil or deliver a Bitcoin or 100 shares of Microsoft or Apple? Don't worry about it. You can get rid of that option anytime you want, whether you're a buyer or a seller. If you bought it, you sell the damn thing. If you sold it, you buy it back before the expiry date and you're golden. So don't worry about that. And there's also very, very good reasons why we don't hold options if we're selling them into that last week. So we're usually getting rid of them, a week before or in the week of expiry because there's a lot more risk called gamma risk. But we'll get into that later. All right, exercise. We just talked about this. We talked about the exercise date. We did talk about exercising. That's when you're basically putting into effect that right to buy or sell that underlying asset. So if you've bought something, you can choose to exercise that option, whether it's a call or a put. Now, exercising a put option allows you to sell the underlying, at that stated price in the time frame. And exercising the call option is the opposite. It allows you to buy the underlying asset at the stated price, which is the strike price and time frame. Now, I need another little graph here. Again, there's only 4 things that can happen. I'm going to reiterate this. Don't worry about this, but it's important to understand it. If we have some calls and I bought it and it's in the money, if it's worth it for me, I'm going to get some cash if it's cash settled, or I'm going to get the security. Okay? I'm getting it because I've got the right to buy it. So obviously the writer, the person who sold it, has to sell it. They've got to deliver it to me, right? They've got to deliver it. Same with, or the other side with puts. If I bought a put, I'm going to deliver that cash as security if I'm the buyer. And if I wrote it, I'm going to receive it. You can always come back and look at these little graphs later if you're doing mental gymnastics trying to figure out what's what. It's normal. Okay, don't get freaked out about it. All right, let's talk about the bid and offer or the bid and ask. All assets have to have bid and ask prices. Otherwise, you wouldn't know what price to buy the damn thing at, right? Because what price is it? I don't know. Well, there's the bid and there's the offer. So, it's right there. The bid is the price that another trader, broker, market maker, exchange, whatever, is willing to pay for that asset. And the ask is the price that others are willing to sell it at. Now, I made up a little infographic here. All right, so you got the bid on the left, the ask on the right. And the difference between the two is called the spread, right? So if you've got something, the highest anybody's willing to buy something is $13, and the lowest anybody's willing to sell it for is $14, well, the spread is $1. That's it. Very, very simple. I made up another. I took a screenshot here. This is Coca-Cola, just some random screenshot I found. Here, you can see the bid, $51.33. The offer, $51.35. So that's a 2-cent difference. That means the spread is 2 cents. If you wanted to buy this asset, let's say you wanted to buy Coca-Cola. You're like, yeah, I want to buy 100 shares of Coca-Cola. Well, you could join the bid. You could join these guys over here at 51.33. What is it? I don't have my glass on. I think it's 800 shares there. So you could put your bid in. It would go up to 900 shares, and maybe someone would come along and sell them to you. Or if I really wanted them right now, what I could do is I could put my bid in 1 cent higher at $51.34, and I would create a new high bid. Or if I really, really, really wanted it, I would just hit the offer. I would pay $51.35 over here, give up that 2 cent spread, and boom, get filled immediately. People cross the market all the time. If I need to buy it, boom, I'm just going to buy it on the offer. So sometimes I'll sit on the bid and do it, and there's various reasons why I would do one or the other. But let's say I needed it right now. I'll just buy it. If people didn't cross each side, there'd be no trading going on, right? Everybody sits on this side and say, no, I'm not going to go over there. And these guys are, no, I'm not going to go over there. We just sit there all day and nothing would happen, right? So it's common to, just buy on the offer or sell on the bid if you need to get in or out of things. Now, as you learn and as you begin trading, you will come to understand that the spread here, the difference between these two, most typically when we're talking about very thinly traded things, there's not a lot of people trading it. There's not a lot of volume there. The spread can be really big. It can make a big difference on the price you get. So let's say here in Coca-Cola, I wanted to buy 10,000 shares of Coca-Cola. Well, look, there's 1,300 here, 1,700 there, 1,000 there, 1,700. So I need to hit, all the way up 4, 5, 6 levels more to get all 10,000 shares, and that would move the price up to, around 51.41, 51.42, somewhere around there. If this is very thinly traded, for all I know, it could take me all the way up to $70 to get out. Even though the market looked like it was trading around $51, $52, it could really take a big chunk of cash away because I'd have to pay that big spread. So it's very, very important. I mean, we're usually trading things that are very robust, very widely traded, a lot of volume activity, and very liquid, which actually is my next term, liquidity. Now, liquidity is generally referred to how easily or how quickly you can get in or out of a market. You can buy or something, okay, in that secondary market. You can sell it fast without paying that big spread or big fee. So if you need to sell something right now, you don't want to monkey around trying to get a fill or seeing 5% of your value eroded just because of the spread. That would suck, right? So you want to stay in liquid stuff as much as we can. Okay, so here I threw up this example. Coca-Cola stock. We're talking about liquidity. Well, we want to know how many people are on each side. So I've just circled here the size. That's how many shares are offered at this particular price. There's 800 shares, 1,200. On the offer is 1,300, 1,700. That's good liquidity. If I come in with a share for or an order for 100,000 shares, okay, that's going to move the market. Now, normally when you have big block orders like that, there's other routes you would take. You wouldn't just put your order through this, but you probably understand what I'm trying to say. A tight spread. There's plenty of buyers on and sellers on each side of the market. You're going to get your fill at a good price, and you're good to go. All right, so long and short. So very simply, if you're long, it means you've bought something. Doesn't matter if it's a call, if it's a put, if you think it's going up, if you think it's going down. If you bought something, stock, oil, doesn't matter. You are long that asset. If I buy Microsoft shares, I'm long Microsoft shares. If I bought gold futures, I'm long gold futures. If I bought Bitcoin puts, I'm long Bitcoin puts. It just means you bought something, okay? And on the other side is short. It means that you've sold something, but sold it to open, meaning you have a short position. So let's say I had some gold and I'm like, oh, I'm long gold. Well, if I sell that gold, I'm not short gold now. I've gotten rid of it. I'm flat, right? So that sometimes that terminology mixes people up. They think, oh, I've sold it. I'm short. No. If I have nothing, if I have no position right now and I say, you know what? I think gold is going down and I short sell it, which means I want to sell it high and buy it back low, make the difference, the exact opposite of buy low, sell high. That means I'm short that particular asset. So I hope that makes sense.
Okay, so there's a bit of history to this terminology. It originates in the mechanics of shorting stocks. Strictly speaking, when you short a stock, you first borrow the stock from someone who owns it, and then you sell that stock that you just borrowed. If the guy who lent you the stock wants his stock back, you are short of it. You would need to go back into the market, buy a stock, and then give it to the guy to settle up. Thus the term shorting comes to mean selling something that you don't own. Now traders are a lazy bunch and they like to speak to each other in shorthand. What's the opposite of short? Long. So when you sell things, in general you're short, and when you buy things you're long. Now of course when you're short puts, you're actually long the market, and when you're long puts, you're short the market. But we'll get to that.
Okay, settlement. Well, that's that process. for the terms of the contract, or that options contract, when it's resolved or when it's exercised. But there's two types of settlements, right? There's cash settlement and physical settlement. So cash settlement, if there's any value in an options contract expiry, then the profit is paid to the holder, to the buyer of the contract, right? So if it's worth anything, so it expires in the money, it's just settled in cash. Simple. Most options we trade are cash settled. You don't have to worry about receiving 1,000 ounces of gold or bushels of wheat or a Bitcoin or shares in a stock. First of all, we don't hold options to expiry usually. Second of all, if it is against me when it comes time to expiry, it's just a cash difference. It's the cash difference between the market price and the strike price. That's cash settlement. It's very, very simple. The reason they exist is really to simplify the whole process. It's a lot easier. You don't have to worry about all this stuff. And it eliminates a lot of expense. So let's say you're trading an index, like you're trading the S&P 500. Well, if it expired and it's in the money and you sold it, how are you going to deliver 500, fractional shares of these 500 companies and they're changing that would be very cumbersome, if not impossible to do on a mass scale. So it makes sense. It's oil, you don't want, an oil truck backing up to your house tomorrow saying, oh yeah, here's your oil, buddy, where you want it. Now there are very good reasons why you would want to take the physical. You want the shares, so you want to sell the shares. Or let's say you're a jeweler, you've got a little jewelry factory or a little business, and every year you use 1,000 ounces of gold or something, I don't know. Well, you might want to use options or futures contracts to hedge it or to lock in prices and actually take physical delivery of that gold and know what your price is versus, what's the price going to be in 3 months if I need it in 3 months? I hope I don't get ripped off. Industry uses it in that way all the time. All right, so cash settle just kind of makes sense. It's much more simple. Cryptocurrencies, which we trade a lot of, as you're going to see, and that's where we love to trade, high volatility, are cash settled. Makes things very, very simple, very, very straightforward. All right, strike price, we talked about this 100 times already. You should already know what it is. And it's in that contract, the options contract, that is the price. That's that predetermined price where the option can be exercised right up until the exercise date. Now, I put a little chart in here. I'm going to try and do little charts and stuff all the time, just to clarify things. Some people verbally learn, some people are visual, some people need a little bit of everything. So I just want to reiterate some things. If you buy a put, generally, the put buyer wants it to go down, right? They're going to make that difference. So if I bought this $100 put, it goes down to 90, I'm up $10 on those options. It's a wonderful thing. At expiration, though, the person who wrote this, who sold this, is going to have the obligation to buy it at $100. Oh man, they have it put to him at $100, regardless of the fact that it's at 90. So he's going to lose $10. The buyer of that put is bearish. They think the price is going to go down. The writer of the put is bullish. He thinks the price is going to go up or stay here or maybe go up a little bit, maybe go down a little bit, but not enough for him to lose money on this. So I'm starting to plant some seeds here. The buyer has to be exactly right, and his timing better be damn good. The seller, not so much, but there's risk. Let's just keep that in our minds. So let's look at the opposite side. Let's look at some calls. A call buyer at expiration wants this thing to go up. I should have put at expiration, the buyer wants it to go up, but I didn't write that there. I'm sorry. But the trader who wrote this, who sold these 100, maybe the price was at 90 at the time, and he sold these 100 calls. Maybe it's good for 30 days, whatever. Okay, fine. He's got the obligation now. If it goes up to 110, he's got the obligation. He's got to sell it at $100. Oh man, he's gonna have it called away from at $100. But it's worth 110. He loses out. There's a set-off. The guy who bought it makes $10. The guy who sold it would lose $10 if it was held to expiration. The buyer of a call is bullish, as I mentioned, right? Wants the price to go up. Seller of the call, the writer, wants the price to either go down or not go up very much. Or stay down here just for a while, let that option become less and less valuable and buy it back cheaper and move on to the next trade. Okay, here's another really important thing too. There's American style and there's European style of options. There's only two options. There's calls and puts, but there's two styles of options. There's two types of options, okay? American option gives the holder the right. Remember, if you buy, you got the right to exercise that option at any time between the time you buy the darn thing and the time it expires. Well, that's interesting. Okay. As you can imagine, European options are the exact opposite. They can only be exercised at the expiration date. In the past, American exchanges, like way in the past, used to do American-style options, and European exchanges, European options. That's how they got their names. But now, it doesn't really matter. It just refers to the style. You'll find that you'll get both types all around the world, the different types of exchanges and different types of assets, okay? Generally speaking, we're trading European options. I prefer European options. Now, American options have... They can be priced a little bit differently, and they have different uses and different functions. But for the most part, I trade European options because I don't want to worry about it. I don't want to worry about it because sometimes I might not look at the market for 5 days. I don't care. If it goes in the money, out of the money, in the money, out of the money, I don't want to worry about getting exercised because I'm typically selling options. And I'm typically waiting for the time value to go down, 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 and I'll buy it back. So I prefer European style options, and most crypto options are European style. All right, open interest. This is just simply the total number of outstanding contracts that have not yet been settled. So total open interest does not count every single buy and sell. That's the volume, right? Rather, it provides a picture of options trading activity and whether money flows into the option markets is increasing or it's decreasing. And I did up a little graph here just to show you. So let's just say this is a brand new option contract. Boom, it's open this morning. It's now available to be traded. Okay, wonderful. Some trader A comes along here and he buys 10 contracts. Okay, well the volume is 10. Later that day, he sells 3 of them. Volume is 10, open interest is 10. There's 10 open contracts. But then he decides to sell 3. Well, the volume is 13 because he bought 10, sold 3, 13. But the open interest will decline by 3 contracts because only 7 open, 3 were closed, right? Some other guy comes along a little bit later and he sells 4 contracts. Well, 13 plus 4 is 17. Those 4 contracts are added to the open interest because he opened some new contracts. He sold 4 to open. So it just tallies the amount of contracts that are open. And open interest is something we're going to come back to a little bit later on because where we see open interest, when we're looking at what's called an options chain, we look at the quotes, kind of like the bid and ask I showed you earlier for Coca-Cola. We're looking at the quotes. The open interest can give us clues as to where we should maybe consider putting our prices around. It also provides a lot of liquidity. And we talked about that earlier. We want to be able to buy and sell rapidly. We don't want to be working with some options contract that there's hardly anybody doing anything. There'd be nobody to execute against, right? So we want to make sure that we're in the action. We've got the ability to get in and out of that market. Okay, so let's talk about in the money. And I've mentioned this term before, at the money and out of the money. Now, an option can be any of those 3. It can't be those 3 at the same time. It can only be 1 at a time. But basically, if an option is in the money, it means it has intrinsic value. And I'm going to cover that in the next lesson. So the call option is in the money if the strike price is below the underlying price. That's what we want, right? If we think something's going up, we want to buy it. We want the price of the market price to go above our strike price. So it's in the money if that strike price is below the current market price. And the exact opposite is true of a put. Now, at the money, very simple. It just means the strike price and the underlying price are right about equal, very, very close to each other. And an out of the money option, I should have made that yellow there. For a call option, the underlying price is below the strike price. For put option, the option is out of the money if the underlying asset price is above the strike price. All right. That was a little bit of a long video, and I know I tend to waffle on sometimes, but we're going to get into the meat of this. This is terminology. This is not fluff, but it's easy to kind of go down some rabbit holes and get some background on it versus just reading some definitions off. I mean, that's boring, right? Nobody wants to do that. Let's get a deeper understanding of this. Let's understand the terminology. Let's understand the function behind options. Let's do some mental gymnastics if we have to as we get into this stuff. But that's really a handful of terms you're going to see and use and hear all the time going forward. And as we come across new terms, we'll just tack them on then. So I'll see you in the next video.